And we are officially live, broadcasting only on onedealaway.com/live. This is Money Matters. My name is Nev, and today is Thursday. But today is a very, very special day because we're not only broadcasting on onedealaway.com, we're actually going to attempt to broadcast simulcast on onedealaway.com as well as the Facebook going live. So today we're going to be talking about real estate, and once we roll out into the whole audio visual whatever thing, we're going to go and explain exactly what is going on, what we're going to talk about, and it's going to have a lot to do with mortgages and with real estate around the world. Let's do this. All right. Good morning. We should be now, unless I have completely killed my computer, which is possible. We should be now broadcasting on onedealaway.com/live, as well as the Real Estate Investing Secrets Facebook group. So I don't know if this is happening. I have too many windows open, too many trying to figure it out. But I am excited to attempt to do this. So if this goes horribly wrong, my sincere apologies. I'm attempting also to record it on the local machine. So if all of the broadcasts implode, I will hopefully have a show to share with you at the end of this whole thing. I am petrified that something is going to blow up, that the machine is going to melt, and I'm going to lose everything I have ever owned on this computer. But I am very, very excited, and I do want to welcome everybody who is watching this live. Hello. Say hello. I don't know that I can see all of the chats and everything else that is going on. Maybe, I don't know, my Facebook thing is looking very different. I can definitely see you. You are on onedealaway.com. So wherever you are, feel free to say hello, and sooner or later I will find you. I will say hello, and we can definitely hang out and chat and kind of that kind of stuff. So anyways, today we're going to be discussing quite a bit about real estate because it is Thursday, and on Thursdays we always do real estate news and updates, and boy, do I have news for you all. It is going to be talking about the home foreclosures and what's going on over there, but we're also going to be talking some good news and some bad news about the whole thing. So let's start with mortgage, because mortgage is very, very important, as you know, in this entire industry, because that's what guides ability to buy or not buy and so on. So here we go. What's happening? I started to read this stuff, and it says, oh, amazing thing is happening in Australia. So if you're in Australia watching this, whether right now live or watching it at some point later on, that's perfectly fine. But they are actually starting to offer mortgage rates well below, and I don't know why it's not populating the whole thing. So I guess well below 2%. That's right. So I saw this and I was like, holy mackerel, this is amazing. What is going on? I need to read more about it. But I think as we go more through it, and I am not trying to be mean or evil towards anybody or any country or anywhere, I am just sharing my experience, and in my experience, real estate in United States has the best deals, like the financing and everything else. And I think you will come to the same conclusion once we actually roll over, because we're going to be talking about Australia, we're going to be talking about Canada, and we're also going to be crossing across the pond, as they say, and visiting our friends in United Kingdom. So 31 lenders offering mortgage rates under 2%, and I'm going, this is amazing. And they talk about how because the bank's recent rates are basically cut down to 0.1%, so basically zero, there's a lot of lenders that are cutting their interest rates, right? And so they're coming in and they're putting it in and cutting to the variable rates and as well as their fixed rates. And I'm going, ooh, cool, fixed rates, like this is amazing. And fixed rates under 2%, and I'm going, this is cool. But then I started to look, and let me actually zoom in right now because I have tried to show you the whole thing. When they say fixed rate, Here in the United States, we're very spoiled. When we say fixed rate, we're talking like 15 year or 30 year, right? Over there, they're talking 4 year, 3 year, 2 year, 1 year. So as you can see, it's not really fixed long term. I mean, it's fixed, but in United States, we would call this a 4-1 arm or a 3-1 arm, or variable altogether. So as you can see, while they are offering these super low fixed rates, they're not truly fixed, if that even makes sense of what I'm kind of saying, right? So hopefully it does make sense, and hopefully you are picking up on kind of what I'm saying. But it is kind of exciting to see this. Now, are we going to see lower rates in the United States? I don't know, but we're going to jump now to where are we going now? To UK. So, welcome to United Kingdom. I should have known it by the photo, but you never know. Sometimes they just recycle the photos and you don't know where you're landing in anyways. So, rising mortgage rates are squeezing home buyers in the United Kingdom. So, what's been going on? Well, as you know, United Kingdom is expensive to begin with, right? London real estate is ridiculously expensive, to the point where, like, I feel like now you can buy like a square foot of a bathroom, and you might be able to need to mortgage it for a few years. So it's ridiculously expensive. It's ridiculously difficult. More and more people, when they're leasing flats and that kind of stuff, they're really leasing apartments and stuff. And we're not talking college age students. We're talking full-fledged adults with a job who are seriously dating somebody else. Sometimes they're actually young couples. Whether they're married or not, that's a different story, right? But they're going in and buying the stuff because, and so now the Bank of England has been keeping interest rates at a record low of 0.1%. I think you're catching on probably to to sort of like a string of what's happening, right? A theme around the world that the federal banks, the central banks are holding the rates at basically zero. Everybody's at zero or negative. And so that's an interesting piece that is kind of going on. And of course, the prices will continue to kind of go up and climb up. But what has happened is that since COVID, what they're saying, capacity to deal with the surge in applications and buying and all of that stuff, staff can't process, and so they can't take on much risk in today's climate. And of course, what is going on, the average rate on a 2-year fixed rate mortgage, again, another trend that you will notice, when they say fixed, it's not fixed forever, it's fixed for a short period of time. But what happened is that the fixed rate mortgages rose 0.44 percentage points between July and November, going from a low of 1.99%, which is what we're seeing in Australia right now, all the way to 2.43%, which is kind of where we are in the United States, plus minus, right? But the problem is that when you go from 4% to 2%, you can refinance. When you go from 1% to 3%, you can still refinance, but now it's costing you way more. So this is the part of the problem, and what is causing is that individuals are potentially creating this unaffordable spectrum that is going on. Now, we're going to jump into beautiful Canada. And in Canada, there are signs that the fixed rate mortgages could soon become more expensive. And this is coming, this is very recent, but it's coming out of Vancouver, Canada, stating basically that it could soon get much more expensive to get a 5-year fixed rate mortgage. So, what are we talking about here again? Trend, right? Starts with the low. At some point, it's going to start going on up. And when we're talking about, so far we looked at Australia, we looked at United Kingdom, we looked at Canada. And when they talk about fixed, we're talking 2 to 4 years. Right? 5 years. 5 years in this case scenario right over here. 5 years. So that's an interesting piece that I'm like, I don't know. Like, is that the exact same thing, for us? But now you might be thinking, oh my gosh, like, how blessed am I to live in the United States? So forever I've been telling folks, look, we are incredibly lucky to be living in United States, to have rates as amazing as we do, to have deals as amazing as we do. And it's very, very important for you to think through, what is going on in the country around you. And when you start looking outside, it makes perfect sense why you were like, wow, now I understand why Nev keeps saying that some of the best deals are in the United States. Now that doesn't mean that you can't invest really well outside of the United States. I'm just saying when it comes to the mortgage and everything else that you're able to do, this whole 0% down or 3% down and that kind of stuff, that doesn't exist in vast majority of the world. 30-year fixed rate mortgage doesn't exist in vast majority of the world, which is why a lot of the international folks are coming to the United States and investing here. But now it's time to switch over and let's talk about what is the best personal mortgage and refinance rate as of Tuesday, November 10th. And let's take a look at what's going on here. So refinance rates have fluctuated a bit. 30-year fixed refinance rates are up, 15-year rates are down, and 10-year is basically flat. Now, fixed rate mortgage is probably a better idea than adjustable rate mortgage right now. Why is that? Well, let me see if my computer, let's see if I'm going to kill my computer completely trying to get let's see what else it could do. And then I'm going to kill it completely. But what you want to take a look at right over here is that, we've just talked about, say you purchase a home right here, right? And it's going to cost you $100,000, right? And if you're able to finance it, let's say 100% financing at 1%, right? That's cool because that's $1,000, right? Is my math correct? If it's not, correct me, please. So what ends up happening is that if you get not fixed rate, right, and this one right over here goes up to say 3% a year from today or 2 years from today, which is what is happening in UK as we just saw happen, right? All of a sudden this $1,000 becomes $3,000. Okay, that is a huge difference because this right over here you could potentially afford. This completely kicks you out of the game, and that is why it's important that if you can get a fixed rate, and of course if you can get it for as long as you possibly can, right? So if your country only offers 1 or 2 years, I mean, it is what it is, right? But you got to be very, very careful because right now we're at the lowest level. At some point, now it might not be this year, it might not be next year, but at some point those rates are going to increase. There is no ifs and buts about it. It's going to happen. You can't have this for forever. I mean, you could for a while, but at some point things are going to implode anyways, and so you want to be very smart about the whole thing. So what is happening? The best mortgage rates Tuesday, November 10th. So we're a couple days behind, not really, but here we go. Mortgage rates, 30-year average rate as of November 10th is 2.78%. Last week was 2.81. Average for the month 2.87. That is a pretty darn good rate. 15-year fixed is 2.32. It's been 2.32 for the week and slightly higher over the last month, but not by much. And then you have the 5/1 ARM, which is basically fixed for 5 years, and then it fluctuates whether with prime, with LIBOR, which is going away. So it's not going to be LIBOR, it's going to be something else, and they're going to reconfigure what that else is going to be once they figure it out. They're trying to replace it with SOFR, but that thing is still they're starting to switch things over, but it's not a guarantee, it's not a done deal, so to speak. And as you can see, that thing is basically remaining flat right now. But one of the things that is also interesting is that we want to look at about today versus 6 months versus a year ago, and I think that tells a very good story of where we are. And this is coming from the Federal Bank of St. Louis. So 30-year 2.78 right now. Well, 2 days ago, but let's say right now. 6 months ago it was 3.26. 1 year ago was 3.69. 15-year fixed went from 3.13 a year ago down to 2.73 6 months to 2.32 right now. So it looks like our 30-year fixed right now is where 15-year fixed was 6 months ago. And then 5/1 went from 3.39. It used to be the most, not the most affordable, but more affordable than 30-year. Went down to 3.17 and is now at 2.89. So this is kind of an interesting piece to consider and to pay attention to. And so again, folks are still refinancing. One of the interesting things that I haven't done, and you know what, we should probably do this. Yahoo Finance, Yahoo Finance. The reason I want to go to Yahoo Finance, y'all, is because I want to look at what's happening with the 10-year 10-year treasury. Okay, if my computer, like I said, I might be killing my computer over here trying to do, because I'm trying to do one too many things right now, and so things might not be functioning as well as they are, but God love the computer for the fact of keeping up. And you can see, okay, here we go, it's coming up. 0.958%. So we've seen that the rates have been climbing. So here's a 1 month thing, and you can see that the rates have been steadily climbing. We're hitting or coming close to that 1% rate, and so this is going to be a very important thing for us to acknowledge and consider, that because mortgage rates are connected to this puppy. So it's kind of important to have this component and this sort of in the back of your head. So when you're watching it, it doesn't happen simultaneously, but it does happen over time. So that's the reason why we could potentially see, an uptick in the rates. So if you're thinking of refinancing and so on, it might be a good time to kind of try to get it done. We don't know what the future holds, and we're going to be looking at some of the what the future holds, when it comes to the real estate stuff. So that is what we're going to talk about right now. Mounting commercial real estate losses threaten banks and recovery. So what in the world is going on? Well, it's one of the things that I think we've been talking about for a little while in the previous shows, and if you haven't watched them, you can find them on the YouTube channel, which I failed to mention that if you're watching this live, welcome. If you're watching this live on Facebook, welcome. And if you're watching the replay on YouTube, welcome. But you can find the replay of the stuff on the YouTube channel, and I try to kind of, play around and cover everybody and answer all the questions. So wherever you are, if there's a thumbs up button right about now, would be a really good idea and really helpful if you could smash that thing right now. If nothing else, for the fact that I am attempting to stream live on multiple platforms and record it just in case things blow up, so that you can still have it. So I think that alone deserves like 2 thumbs up. But I don't think that the profiles have 2, they only have 1. And of course, subscribe to the channel, hit notifications, invite others to join the Facebook group if that's where you're watching. So anyways, help me help other people is what I'm asking. All right, a hint of financial storm that could be about to break over the U.S. economy in 2021. The Manhattan Bank last month set aside nearly $53 million to cover potential loan losses, mostly due to pandemic. Lending money to shopkeepers, landlords, hoteliers, and places in Times Square, Soho, and so on was pretty much guaranteed until the pandemic, where everything got locked down and then people left. And now many people are calling New York City basically a ghost town. Although it's not in this article, but I have read in another article. There's just so many articles we can do in a day, right? But I have read in another article that because the rental prices, obviously have been decimated in San Francisco, but also in New York, that some of the younger people are starting to move back into the New York City area. Now, is it going to be an immediate? I don't know. This is one of those like timing and risk and what you believe in. Do I think New York City is going to disappear? No, I don't. I honestly don't think that that's going to happen. Do I think it's going to shift and change? Absolutely will. How is it going to change and shift? I have no clue whatsoever. I really don't know that one. I mean, my crystal ball broke, and so I don't know. I'm kind of watching for the signs and trying to figure out what do I think things could look like. I mean, it's probably, if the real estate prices go down, it's probably going to bring younger individuals, more diverse population. I mean, New York was diverse to begin with. I think new kinds of shops are going to come in. I think, new way of thinking about stuff is going to come in. So we'll see. But a lot of that stuff is going to have to be, by the laws and the regulars and taxes and the the whole structure of doing business and living somewhere. And so there's a lot of complicated things, and we're going to be taking a look at some of the complicated things that were attempted to be resolved by a quick fix during a proposition in California. Yes, we're going to go and fly to California in a moment and talk about LA real estate market. So if you're interested in that, you definitely want to stay tuned in. And as you know, sometimes what happens in LA tends to spread outside of LA and outside of California. So definitely important thing to pay attention to. But anyways, as you can see, there's potential problems looming. Now, Signature, which nearly sold 60% of its portfolio tied up in commercial real estate, is bracing for the fallout. The bank's bad loan write-offs, though still modest, are creeping higher. If U.S. banks absorb big losses in their $2 trillion in commercial real estate loans, the entire economy will suffer. $2 trillion, that is a lot of money. A lot of money. And so, it will be interesting to see what happens. Do I think that the Fed and the government will let them all fail? Probably not. Do I think that all of us will be bailing all of this out? Probably yes. It's just a matter of time. We've heard it from all sides that there will be some sort of stimulus, whatever thing coming in. Is just, I think Trump right now is trying to figure out was there cheating, was there not? I don't know. You can have your own opinion. I know everybody has their own feelings and opinions about it. I have no clue. If it was rigged, not rigged. I just know history will tell the truth at some point. Sooner or later, we'll figure it out. So, he's trying to figure that out. Biden is trying to put his cabinet together, but he can't do anything until, later in January, but he's trying to get a head start. So it's been a very interesting kind of crazy thing that I just try to tune out, and I'm like, let me just focus on things that I know and love. But anyways, it's going to be interesting to what happens, but I do think that if this starts rolling out, there will be stepping in because, again, we didn't let the economy implode in the 2008 fiasco. We didn't let it implode in the March closure fiasco. I don't think we're going to be allowing it to implode in the, early January, February fiasco, especially not if Biden, if the whole lawsuits and that kind of stuff doesn't, turn into anything and Biden actually ends up becoming the 46th, I think it's 46th president of the United States. Do you really let the economy fail in your first month at a job? Probably not. So you do whatever you can to be like, I don't think so. I mean, let it fail 2 years later, a year later, give me something. So anyways, it's going to be an interesting thing to watch. Tighter credit standards make it harder for commercial borrowers to roll over old loans. Banks have repeatedly failed after stumbling into big losses on commercial real estate loans, from the savings and loan crisis in the 1980s to the Great Recession in 2008. Now, in 2008, U.S. banks lost $110 billion on commercial real estate, right? That was the last crisis of what has happened. This time around, everybody's saying, and I agree, and I think you can tell as well, that the losses are going to be even worse. And if a coronavirus vaccine becomes widely available in the first half of 2021, people may revert to their old habits. But some societal changes may endure, right? So we'll see kind of how things work. I mean, we'll see where the vaccine is going. I think that there's a lot of hope. I think that there's a lot of people that don't trust it. I don't trust it just because it's being rolled out so quickly. I'm like, yeah, I'm going to let you test it on somebody else before I have to do this, puppy. I don't know what's in it. Last thing you know, I'm going to grow out the third arm. Although that actually could potentially be very helpful because, these two, sometimes it gets too much. So having a third or fourth arm could actually be good. So I don't know. Maybe I'll consider doing it if that's what the side effect is. But anyways, right, so not everybody's going to change stuff. Even when we started reopening, not everybody was crazy about, going out there and going to the shops and going to the concerts and that kind of stuff. Some people are, most people are not. So even with the vaccine, I don't know, some of the habits just might not come back. But shifts, if the things don't shift back to what it was, right, could actually make the downtown office buildings, hotels, stores much less valuable. And we've also seen and talked about in the show previously, and again, go back to the YouTube channel. It's all recorded over there. And you're able to watch it. And if you don't watch it, you can just put it in your pocket and listen to it, I guess. But we've already seen that there's a lot of write downs on the hotels and office buildings that are happening. And of course, they are being written down, 50%, 75%. So it's big write downs. Office space, the largest single slice of the commercial real estate sector, already is seeing rents fall. Property values eventually could plummet 20 to 35%. This is coming to recent Barclays report. Hotels and retail properties have been hit even harder. Now, I actually think that the property values eventually could plummet more than 20 to 35%. I actually think that when we're talking about office space, we could see that go about 50%. That's just my personal / professional opinion. It's not a guarantee, nor should be used as financial advice, which, because, by the way, nothing I say on this channel or any other channel is or should be used as a financial advice. Period. End. Done. Out. Let's go. Okay, so Federal Deposit Insurance Corporation regards 356 banks, one bank for a day of the year, I guess, as concentrated in commercial real estate, based upon criteria such as the ratio of the commercial real estate loans to their capital base and the pace of loan growth over the past 3 years. Valley National Bancorp in Wayne, New Jersey, is the largest bank to exceed the regulatory guidance. Its CRE loan portfolio has grown by 81% in the past 3 years, and this is according to S&P Global. That is huge and very scary. And of course, the more they are kind of in it, and the larger probability or potential of things imploding, the greater probability is that that bank might fail or be acquired by somebody else. So we'll see. I think some banks will fail, but then I think that the other ones will be kind of acquired. And the sad part is that mostly the smaller banks are the ones that are going to fail, and the larger banks, they're too big to fail, right? Too big to jail, too big to fail, right? So that's kind of where I see potentially things happening, just like they did in 2008. But instead of residential, it's going to be commercial real estate. In the event of another such crisis, most banks will be affected and many might fail. The CRE sector remains a potential source of instability for the banking sector. In the second quarter, banks reported the largest percentage increase in large offs for bad loans since early 2010. I don't see any way of avoiding a great deal of pain in the commercial real estate market in 2021. Former president, Independent Community Bankers Association, basically said that, quote, "My friends at the Federal Reserve and the FDIC are becoming increasingly uncomfortable with what's happening in the commercial real estate space. President of the Federal Reserve Bank of Boston is throwing alarms and red flags everywhere, basically saying that commercial property values were artificially inflated by more than a decade of ultra easy money." And that was one of the things I think I have been sharing with you as well, that I have been looking at, like student housing and stuff. And I'm like, man, it doesn't make financial sense. It doesn't make financial sense because everybody was banking it's going to go up and up and up and up. And then 5 years from now, you can make money. Same reason that I said, it doesn't make sense to buy right now in certain places like LA, San Francisco, Miami, Portland, Oregon, Seattle, New York, Chicago. All of those places were ridiculously overpriced, and now the prices are starting to come down in all of those areas. I'm especially worried about second shoe dropping that will particularly affect small and medium-sized banks, which provide a large share of commercial real estate loans and small business loans. Water break. Okay, thank you. So here's what happens, y'all. When you are buying, I'm going to highlight this over here. When you're buying commercial space, and commercial space is even the apartment units, anything 5 units and up is considered commercial real estate. So when you're buying commercial real estate, you go onto the commercial lending component, even if your commercial is housing, right? Multifamily housing. And so when you enter that space, there's like a limit threshold of what people will or what banks will lend on that makes sense. And a lot of the multifamily stuff, the banks, like vast majority of banks, won't even look at you if it's less than a million. Some of the banks it's less than 10 million. Then there's some that is like, if it's not at least 100 million, we're not even having a conversation with you. And so what ends up happening is that typically it's the mom and pop, small business investors, individuals like you and I, that end up acquiring some of the multifamily properties without the syndications and the crazy stuff and all of that, on our own. But those properties typically end up costing less than $1 million, right? And so what ends up happening is that you can't go to JP Morgan Chase to borrow. Not that I would potentially want to, but I don't know. But they're not even gonna answer the phone for me. Like, their website won't open for me, is how that's not valuable to them. So you have to go to smaller banks, to local banks, to regional banks, to credit unions, and that's the part of the problem, because they're too small, for the big government to care, so they just let them fail. That's the unfortunate piece. So the small and medium-sized banks basically lend to all of the small businesses, but who is right now struggling? It's small businesses, because small businesses are the ones that are being affected the most, because large business, well, they basically go in these giant credit markets and stuff, can go in, get all these crazy bonds and stuff for like, dirt cheap. And the rest of us, when we go and borrow, they want collateral. They probably have to deposit your firstborn as well, even especially if it's a small business administration. And then, it's a good rate at 6%. And I'm going, wait, what? But that guy over there, giant business, is borrowing for 0.6. And you're charging me 6%. And this is the part of the problem. And so that's kind of where the challenges are lying. In the third quarter, Signature reported making $1 billion in new loan, a 75% drop from the previous quarter. Now, Jerome Powell had stated, quote, "Smaller banks are going to probably bear too much of a burden here. They have more exposure to real estate and to small businesses, which are probably much more vulnerable and have less resources to deal with this sort of stress." And that's true. But what is the Fed doing? Well, not much of anything. They go out there, quote unquote, print, which they're not really printing, but that's what they're saying, right? That's what is being said. Then that money goes on to the ginormous banks, and then ginormous banks are supposed to lend it to all of us, but they are not. And when they are, they again charge you arm and a leg. Now, here's what's been going on. Deutsche Bank, Goldman Sachs, JP Morgan Chase, these are large banks, right? Have bundled about $550 billion, so that's over half a trillion dollars worth of commercial mortgages into securities and sold them as investments to pension funds, life insurance companies, and mutual funds. Like I said, all of this, if it unravels, it's going to hit everybody. But of course, Deutsche Bank, Goldman Sachs, JP Morgan Chase, they will come out unscathed from this. They'll probably get some bonuses out of the whole deal as well. Now, one of the things that is kind of scary is that since the deep freeze in the spring, the share of commercial real estate loans that were delinquent rose to 10.3% in June from 2.3% in April. Now, since then, lenders are basically allowing for delayed payments, the forbearances, that kind of stuff. And of course, this has brought down this share of delinquent loans to 8.3%, but it's a much larger number. It's just that right now you don't have to pay. Let's figure out something 6 months from now. But 6 months from now may or may not change anything. And so borrowers are still behind their payments on commercial real estate loans. And they're saying in this article right here that it's about 8.3 that is still showing as delinquent, and that comes to about $45 billion. Now, disasters are in retail and hotels, missed payments of nearly 20% of hotel loans. Now, here's an interesting story that I said it's going to be more than just 20 to 35%, and I think this supports what I'm talking about. In July, CBL and Associates, a real estate investment trust, was due to pay off its $63 million mortgage, anchored by tenants such as JCPenney and Macy's. CBL surrendered to its lender half of the mall, which it had pledged as collateral, worth $137 million in 2010. It sold for less than $20 million, which is a 85% decline You see what I'm saying? So it was worth 137 million 10 years ago. Now it was sold for less than 20 million. That's a huge decline. At Signature Bank, executives have extended forbearances to some clients, and they're attracting billions of dollars of new deposits and have been reliably profitable for 51 consecutive years. And they're basically saying that they're tapping the bond market for 375 million, paying a lower interest rate. Yeah, so they can, you and I can't. Now, one of the things that they have said right here in the article is they believe it's a timing issue. And if we can keep some of the clients in the businesses and businesses running, New York will come back. Will it come back? Will it not come back? It's anybody's guess. I think it will. I honestly think it will. But again, I think it's just a matter of time. Now, one of the things that we talked about as well, that I promised we're going to talk about, and this is going to be one of the last stories, or the last story of the day. So this is one of the things that is kind of interesting of what has happened. So there's a new California law that makes foreclosure homes easier to buy unless you're a landlord or a flipper. That's right. That's right. California is proving to continue to be business unfriendly. But it's done with a good heart. So please understand that it's done with a good heart, but there's definitely some challenges and stuff. So we're going to take a look at all of that stuff. So during the last financial crisis, millions of Americans lost homes. You already know that. What ended up happening is investors kind of came in, especially large investors. They would buy in, start flipping them, start renting them out. And of course, that's kind of what's been going on. One of the super large firms like Blackstone Group started creating subsidiaries that snapped up tens of thousands of single family homes. Then they would rent them out. Sometimes they would flip them. Since then, they have actually sold quite a bit of it. Now Blackstone is back into, the Fed's pockets doing their bidding and that kind of stuff. And so one of the things that California has done, they passed on a proposition that basically says, well, here's what it says. New rules apply to 1 to 4 unit properties sold at foreclosure auctions. So California is getting ready for giant foreclosures to come its way in the potential, people don't have jobs, they can't pay mortgage, nobody will work with them, banks kind of implode. So they're saying, when that happens, if that happens, when that happens, here's how we're going to play. New rule coming in. Now, you can go into an auction, and if you don't know how those look like and you're kind of curious about that, I actually happen to have a course called Real Estate on the Cheap Challenge. And it's not foreclosures from the bank, it's actually tax foreclosures, but the process is very much the same. I think the one that I'm teaching is much less crowded. There's less people in it, and typically, not always, but typically you can get much better deals. And some of the fears that might happen at these auctions don't really exist at the tax sale auctions, which is why I prefer that one. But I have done this as well, so you can still find amazing deals. Anyways, if an investor wins one of the homes at auction, people who want to live in it, as well as nonprofit organizations and government entities, get 45 days to submit competing offers. If a property that's sold at an auction is a rental, the tenant living at the place could win by matching the investor's offer. Other would-be buyers might offer more than the investor. This is known as SB 1079. The law takes effect January 1st, 2021. So here's kind of what happens at an auction right over here, and then we can take a brief look at the market. All right, so you have a big old beautiful house. Say that it goes into the auction, it bids up, and it sells for $100,000. But let's say that is coming from an investor, big I. Well, let's say that you want to actually live in it, right? So all you got to do is basically offer, I don't know, a $1 more, and the property is yours, and you have 45 days to do it. Now, if you happen to be a tenant that lives in a property, right, then all you got to do is offer the same amount of money, and you get to keep the property. Now, I don't know exactly how it all plays out of like who wins, who has the right, who, is it that I put in 100,000 as investor, you come in and put 100,000 and a dollar, right? Do you win automatically? And then what if there's a tenant and they put in 100,000? Like, who gets first? So that part is not quite clear yet. The goal was to make it easier for individuals to find an affordable housing group to compete with investors. Quote coming from the State Senate's Nancy Skinner, the bill's author. Homeownership is the primary way people have to build up generational wealth. And I think, yes, real estate ownership is an amazing way to build up generational wealth. Will it be home ownership? Will it not? It kind of depends, because there are many people that have had homes, and I don't know that I would argue that their offspring are in the wealthy class, right? So I think that there's an opportunity there, but you could take it whichever way. Now, how could one buy this? Well, the manager of foreclosure auctions is required to maintain a website that details the highest bid at the auction and how to submit competing offers. If you are a traditional home buyer, you got to be careful, right? So, a couple of things that you need to pay attention to. A, if you're dealing with this stuff, you want to, potentially get an attorney, get somebody who's experienced in kind of how to buy foreclosure, and maybe you get an agent who does this, or you sign up for the courses to understand how to do that. So it's really your course, but you want to definitely understand a little bit more. The second piece that you also want to understand is that because this is not a tax deed foreclosure wipes off all the liens except for the taxes, and if there's an IRS anything, they have to show it as well. But you do a little bit of research on the liens to find out, are there any other liens? Is there anybody else that might have an ownership? So there might be some of the other things that you definitely want to take a research on. And if you need help, then you find title companies, escrow companies, they can help you with that stuff. Now, you also need to understand that you most likely won't be able to inspect the property, right? You might be able to drive around, take a look, that kind of stuff, but you can't go inside and walk through it and imagine yourself in the bedroom. Like, it doesn't work that way. Especially if it's still occupied and it has tenants, you're definitely not going in. So you can do the outside inspection, but not the inside. And of course, you are bidding sort of unseen, so you can't send an inspector over there to find out. So you definitely want to have some money set aside just in case things blow up. Now, these are the things, like I said, these are the things exactly that I teach in the auction real estate investing courses and stuff. So if this is of interest, we go into way more detail, but I'm just pointing out things for you to start thinking about now and researching. The other one is that if it's occupied, you end up buying it, ends up being yours, you might have to deal with the potential eviction, especially if right? So you gotta have to deal with that component as well. And the fixing up and stuff. And then the final piece could be finding financing. So traditional financing could be a bit trickier. So you might have again, luck with the smaller banks and credit unions. Like we said, they tend to be much friendlier to individuals, right? But typically, they want to go into escrow, they want to do this, they want to do this. And so seeing that it's some of this stuff, that makes them feel weird. Now, why financing would be tricky? Because most of these, when they go into the auction, they want cash, right? So they're not interested in you saying, well, I'm going to put 3.5% down. Well, good, that's not what we're going to do. So we're going to put in 100% down and then deal with it. So that's one of the challenges that you might have coming in. Now, here's the part that kind of makes it tricky. Like I said, it was a good thought process, not all that great. Because if you have somebody like Blackstone that has access to 0% funding and billions of dollars through their equities, through the bonds, through all of these different things that you and I don't, well, they can, of course, offer cash thing right away and not have to blink an eye. For you and I, that might be a bit more challenging. One of the solutions that you have is to potentially go with a hard money lender, buy it, and then try to refinance for a more affordable rate. One of the things, if you're going to do that, you got to be super, super smart because you want to make sure that you're buying well below the valuation so that you actually have a room to refinance. Because if the price of the home is, say, let me see if my handy dandy drawing thing is going to play along. Oh no, I picked the wrong thing again. Every time, y'all. Okay. Oh no. All right, hold on. So if, for example, what were we talking about? So we were discussing of, see, this is part. I didn't have my Wheaties this morning. Uh, so if you have a property that that is valued at, why are we not writing? That is valued at $100,000 on the market, right? And you pay $100,000 on the market. Let's give it a roof. Um, then there's really not much room for you to try to roll it over. But if the valuation is $100,000, right, and you maybe pay $80,000 through this auction piece, now you actually have a potential 20% equity here, making it so much simpler for you to refinance and then go with one of the more affordable rates, because hard money lending is amazing because you get it fast, but it's not cheap. And so that's one of the things, and they base it off of the property itself, not necessarily you. So if you can get $100,000 property for, say, 50,000 to 80,000, that's amazing. If you can get it for less, even better. Typically, you can't do that through these auctions, but you can do it through the tax foreclosure auctions, which is why I like them better. But anyway, so that's kind of what the process is. You would buy it and then go out there and then refinance, and then you can do that 20% down. You get a 30-year mortgage, and now you're actually in it. So that could be a potential solution. Of course, they didn't talk about that in the LA Times, but we are talking about it here, and that is why you're on this channel, whether on YouTube, Facebook, on onedealaway.com, or on podcast, because I've also started putting these things on podcast so that you can listen on the go. So if you're podcasting, as they say, homeschool high five, which is basically you take both hands because you can't see me because you're listening and not watching, and then you slap them above your head. That's called homeschool high five. That's one of the things that one of my students taught me. That's right. So there you go, folks. There you go. This ends our show. For everybody watching on YouTube, smash the like, smash the subscribe, smash bell notification, and I will see you tomorrow. For everybody else, stay tuned in still, because we're not quite done yet. All right, y'all. I will see you tomorrow, but only if you hit that subscribe and bell button notification. And as I always say, until next time, stay forever money blessed, and do remember, you are only one deal away.